Hello, financial freedom seekers. Welcome to your go-to resource for all things investing. Here, we're all about empowering you to make informed decisions that can help you build wealth over time. For our first dive into the world of investing, we're going to explore the top 5 proven investing strategies perfect for beginners. Imagine being able to navigate the financial world with confidence, knowing you're backed by strategies tried and tested by seasoned investors. From dollar cost averaging to asset allocation, we're going to break down these strategies, how they work, and their potential benefits and risks. By the end of this video, you'll have a solid understanding of these strategies and be one step closer to achieving your financial goals. So, are you ready to embark on this exciting journey towards financial freedom? Shall we dive in? Scene script. First up, let's unravel the concept of dollar cost averaging. Imagine you're shopping for groceries and notice that the price of your favorite cereal fluctuates from week to week. Some weeks the price is high, other weeks it's low. So, to get the most bang for your buck, you decide to buy more boxes when the price is low and fewer when the price is high. That's a rough analogy for dollar cost averaging, or DCA for short, when it comes to investing. In the context of investing, dollar cost averaging is a strategy where you invest a fixed amount of money in a particular investment at regular intervals, regardless of the price. This could be weekly, monthly, quarterly, you name it. The key is consistency. It's like our cereal example. When the price of the investment is high, your fixed amount will buy fewer shares. When the price is low, you'll get more shares for your money. Over time, this strategy can lower the average cost per share of your investment. Now, why would you want to do this? Well, there are a few potential benefits. First, it takes the guesswork out of investing. You're not trying to time the market or predict the best moment to buy. You're investing consistently, no matter what's happening in the market. Second, it can help smooth out the effects of market volatility. Because you're buying more shares when prices are low and fewer when prices are high, you're effectively averaging out the cost of your investments over time. This can potentially reduce the impact of short-term price swings on your portfolio. But, like any strategy, dollar cost averaging isn't without its risks. If the market is in a consistent uptrend, you could end up paying more on average than if you had invested a lump sum at the beginning. And of course, there's always the risk that the value of your investment could go down over time. So that's dollar cost averaging for you. It's a simple, systematic approach to investing that can potentially mitigate some of the risks associated with market volatility. But remember, it's just one of many strategies out there, and what works best will depend on your individual circumstances and risk tolerance. Next on the list is index fund investing. Now, this is a strategy that's all about simplicity and patience. It's like a crock-pot meal for your money. You set it and forget it. Let's break it down. An index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index, such as the Standard & Poor's 500 index. Essentially, when you invest in an index fund, you're buying a small piece of all the companies within that index. Now, why is this a good strategy? First off, it's cost-effective. Index funds generally have lower fees than actively managed funds because they're simply tracking an index, not hiring a team of analysts to pick stocks. This means more of your money stays invested and compounds over time. Secondly, it's about diversification. Since an index fund holds many different stocks or bonds, it spreads out the risk. You're not putting all your eggs in one basket, so to speak. If one company performs poorly, it's not going to sink your entire investment. And finally, it's about riding the market wave. Over the long term, the stock market has historically trended upwards. By investing in an index fund, you're betting on the overall growth of the market, not trying to pick the next hot stock. But remember, while index fund investing is generally less risky than picking individual stocks, it's not risk-free. Market downturns will affect your investment, and it requires patience to see long-term growth. Also, it's important to note that index funds won't typically outperform the market. You're aiming for average returns here, not the home run. So, if you're looking for a cost-effective, diversified strategy that allows you to ride the overall wave of the market, index fund investing could be a solid choice. But as with any investment strategy, it's crucial to do your own research and consider your financial goals and risk tolerance. That's your rundown on index fund investing. Moving on to an income-focused strategy, dividend growth investing. Imagine you're a farmer. You plant a single seed, and over time, it grows into a tree that bears fruit year after year. This is the essence of dividend growth investing. The seed is your initial investment, the tree represents your chosen company, and the fruit, those are your dividends, a portion of the company's earnings paid out to shareholders like you. Dividend growth investing is a strategy that focuses on companies that not only pay dividends but also have a history of consistently increasing those dividends. It's like having a tree that gives more and more fruit each year. The beauty of this strategy is that it generates an income stream that can be used in various ways. Some investors choose to reinvest their dividends, buying more shares of the company, and thereby compounding their future earnings. Others might use the dividends as a source of income during retirement. Now, what are the potential benefits of dividend growth investing? Firstly, it provides a steady income stream, which can be particularly enticing during uncertain market conditions. Secondly, companies that consistently grow their dividends are often financially stable and mature, which can add a layer of security to your investment portfolio. However, as with any strategy, there are risks. One of the main risks is that a company might cut or eliminate its dividend, which could lead to a decrease in the stock's price. Additionally, focusing solely on high dividend companies might limit your exposure to other, potentially profitable sectors. But remember, successful investing is not about eliminating risk, but managing it. By doing your homework and diversifying your portfolio, you can use dividend growth investing to potentially generate a steady income and achieve your financial goals. And that's dividend growth investing in a nutshell. Now let's delve into value investing. This strategy is like shopping for bargains at a high-end fashion store. You're looking for companies that are undervalued by the market. It's about finding diamonds in the rough, businesses that might be overlooked or underestimated, but have a strong potential for growth. Imagine you are at a garage sale and you spot a vintage piece of art that you believe is worth far more than its price tag. You purchase it, intending to hold on to it until its true value is recognized. That's the essence of value investing. You're buying stocks that are undervalued, with a belief that the market will eventually realize their true worth. Value investing involves a lot of research and analysis. You're not just looking at a company's present worth, but also at its intrinsic value. This means you have to dig deep into a company's financials, studying their balance sheets, income statements, and cash flow statements. You're looking for companies with solid fundamentals, such as strong earnings, low debt, and a healthy cash flow, but whose stocks are trading for less than their intrinsic value. Now let's talk about the potential benefits. Value investing can provide high returns if the market corrects its oversight and the stock's price rises to reflect its actual worth. It's a strategy that has been used by some of the most successful investors in history, including the legendary Warren Buffett. But, as with all investing strategies, value investing comes with its risks. The market might never recognize a company's true value, or it might take a much longer time than you anticipated. The company's fundamentals could also deteriorate over time, causing it to lose value instead of gaining it. In conclusion, value investing is like a treasure hunt. It requires patience, diligence, and a keen eye for value. But if done right, it can reward you with substantial returns. That's value investing for you. Last but not least, let's explore asset allocation. Asset allocation is the strategic distribution of your investment portfolio across various asset classes like stocks, bonds, real estate, and cash. It's like setting the ingredients for your financial stew. The proportions you choose to invest in each asset class can significantly impact your investment's risk and return. Now, how does it work? Think of it as a balancing act. Your goal is to spread your investments in a way that aligns with your financial goals, risk tolerance, and investment horizon. For instance, if you're young and can afford to take more risk, you might allocate a larger portion of your portfolio to stocks. Conversely, if you're nearing retirement, you might want to have more bonds and cash in your portfolio for stability. So, why is asset allocation important? Well, it's a risk management strategy. By diversifying your investments across different asset classes, you're not putting all your eggs in one basket. This way, if one asset class performs poorly, the others may help offset the loss. Now let's talk about potential benefits. Asset allocation can help you achieve more consistent returns over time. It allows you to take advantage of the performance of different asset classes, which can help smooth out the ups and downs of your portfolio. Plus, it can be tailored to your specific needs and circumstances, making it a flexible strategy for all kinds of investors. But like all investment strategies, asset allocation also has its risks. The performance of your portfolio will depend on how well your chosen asset classes perform. If they all perform poorly at the same time, your portfolio could suffer. Also, it requires regular rebalancing to maintain your desired mix, which can be time-consuming. In conclusion, asset allocation is a vital part of an investor's toolkit. It offers a way to manage risk and potentially enhance returns, but it also requires careful planning and regular monitoring. So, whether you're a newbie or a seasoned investor, it's worth taking the time to understand and implement this strategy in your investment journey. That wraps up our deep dive into asset allocation. Now I want to hear from you. Yes, you've been listening to me talk about investing strategies, and I'm sure you've got some ideas brewing. If you found value in this content, do me a favor and hit that like button. It helps a lot more than you think. And if you're new here, consider subscribing. We're all about empowering each other through financial knowledge on this channel, and your engagement truly makes a difference. But let's not stop there. I'm curious, which of these strategies resonated with you the most? Are you a fan of dollar cost averaging, or are you more inclined towards index fund investing? Perhaps you're drawn to the potential of dividend growth investing, value investing, or asset allocation. Drop a comment below, and let's get a conversation going. Remember, there's no right or wrong answer here. It's all about finding what works best for you. Can't wait to hear your thoughts. Well, that's a wrap on our tour of top investing strategies. We've journeyed through the landscapes of dollar cost averaging, where we learned the value of consistent investment over time. We explored the vast territories of index fund investing, understanding the benefits of diversification and risk management. We then marched into the realm of dividend growth investing, a strategy that can provide a steady income stream. Value investing was our next stop, where we uncovered the potential of undervalued stocks. Lastly, we navigated the complex world of asset allocation, learning how to balance risk and reward through strategic portfolio diversification. Each of these strategies holds its unique place in the investing world. They can be powerful tools in your financial journey depending on your goals, risk tolerance, and time horizon. Remember, knowledge is your most valuable asset when stepping into the world of investing. Thank you so much for joining us today on this journey through royalty investing. We truly value your time and dedication to learning more about investment strategies. If you found this video helpful, please show your support by hitting the like button below. And remember, our journey doesn't end here. Make sure to subscribe to our channel so you won't miss out on any future videos. Your journey to financial freedom is just a click away. Until next time, keep investing and keep growing.